I believe the next few quarters, like the next 6 months or so, are going to be the most pivotal 6 months in the economy that any of us have ever seen. Which way we're going to go is going to be completely clear in a matter of months from now. Today we're going to talk about three things. There's an interview from CNBC Seeking Alpha, plus there's a publication called Average Joe talking about something that we've been talking about for quite a while now, so I want to address that. Plus we also have to take a look at some of these uranium stock picks that we've been profiling in the Peter Leeds newsletter and how well they're doing now. Welcome to the channel. My name is Peter Leeds, and we're all about getting you profits quickly and easily.
Peter Leeds.
Premium Investor Enlightenment.
This is from Average Joe, and it's the refi nightmare, the refinancing nightmare. Brace for impact from rising debt balances and delinquencies. I've told you guys for such a long time now that there's going to be a big wave of delinquencies coming in, and now it's starting to play out and everyone's noticing it and talking about it. You guys are super smart. You're getting ahead of the game. You're getting in early and you're understanding this before it happens. You don't wait till the last minute. You got to be upstream. That's what we do. Last week, Goldman stated that credit card losses are rising at the fastest pace in almost 30 years. And they don't expect losses peaking until late 2024 or early 2025 for most issuers, like Capital One and Discover Financial Services, for example. And in 3 of the past 5 cycles, growing losses of this magnitude were accompanied by recessions. Now keep that in mind, that part, the recession part, when we also look at the CNBC Seeking Alpha interview that I want to get into. The pressure is on. Delinquency rates for consumer credit and auto loans have soared in recent years, reaching their highest in over a decade and are expected to continue rising. Of course, they will continue to rise. You know that as well. It would be unheard of, almost impossible for things to turn around. All of a sudden, consumers are getting healthier and there's less delinquencies with these ongoing higher interest rates, higher for longer. It's just dragging you across the pavement, and it's going to get worse and worse until the rates start coming down. And even then, there will be a lag effect. When the rates start coming down, it won't fix things at first. It will fix things many months, many quarters down the road. Just like in reverse, when they raise rates, there's a delayed effect. There's also a delayed effect going the other way. Nobody's talking about that, but there will be. In the summer, U.S. credit card debt surpassed $1 trillion for the first time, while average credit card interest rates have risen to 22% from 16% at the start of 2022. Since 2022, the cost of owning a new vehicle has risen 13.6%, making it harder to qualify for auto loans in recent months. Nearly 7% of subprime borrowers, also known as bad credit borrowers, are 60 days or more overdue on their loans. That's higher than the 5% during the Great Financial Crisis, while subprime auto loan delinquencies are already above levels during that same period. So right before a really major economic meltdown, it's even worse than that. And this is what I've been telling you way ahead of time, that there's going to be this tsunami, this deluge of problems with credit, with auto loans, mortgages, lines of credit. And this is for consumers and corporations too. Any entity that borrows money has to pay higher interest rates on it. So if you used to pay $500 on your mortgage, now it might be $1,500 on your mortgage. And people already don't have a lot of extra cash right now. A lot of people don't even have emergency money. Consumers have resorted to borrowing more in recent years, with 70 million more credit card accounts opened in 2019, with 69% of Americans having one, which is up from 65% 4 years ago. A lot of people are living off of credit card debt. A lot of people are living off of all kinds of debt right now. ING's chief international economist thinks that by the second quarter of 2024, Americans will have used up all of their pandemic savings. I'd argue that we've already gotten to that point, but it goes on to say, worried that households have maxed out credit cards and will find it harder to borrow more. And those refinancing from previously locked in lower rates are going to face a sticker shock. What he's talking about there, a lot of times you'll get a mortgage at a certain rate, but every 5 years they review it, even if it's a fixed rate. So then your mortgage rate goes up when they review it. So that's what happens. You were smart to get a fixed rate, but you're still going to be paying a lot more now. Fidelity's Salman Ahmed, who predicts a 60% chance of a recession in 2024 expects a wave of corporate debt financing over the next 6 months to hit the economy. A company which financed itself at 2, 3, 4% is going to be financing at 10, 11, 12% now. That's a huge shock. And forward looking, T minus 6 days, this is an article that came out a while ago, so as of October, so today, student debt holders are expected to make payments again. A recent survey by Jefferies consumer team showed that 90% of those with outstanding student debt are at least somewhat concerned about meeting monthly expenses. But it's like I told you about when they put a pause on evictions, or they put a pause on student loan payments, you put a pause on anything, what happens is it doesn't make it better. It just delays. It puts everybody in one place where they say, okay, you can evict people again now, and all of a sudden there's all these evictions. It doesn't make less evictions. It just delays them and puts them all in a big pile. Student loans, it just makes it harder. They push it down to a big pile so that no one's paying student loans, and then all of a sudden now everybody has to. So here we go. As of today, student loan payments have to restart. We always follow the uranium stocks closely, and a few of the ones that we selected, the whole industry has done really well in the recent months, recent quarters, and even longer than that. We first got into stock CCJ, that's chemical, and it's up 330% from when we first profiled it. And more recently, we've got 45% gains in energy fuels, that's a ticker symbol UUUU. And Denison Mines DNN is up 30%. And does it have higher to go? We believe so. The reasons that we liked it in the first place, that brought the stock up 330%, we think that a lot of those drivers are still going to be pushing stocks higher. They will give back a little probably after the rampant rise lately, but long term and medium term, we think that uranium is going to be a great investment to be involved with. And shout out to analyst extraordinaire Stephanie. She has been crushing it lately, especially with a lot of these selections. And at CNBC's Seeking Alpha conference, they had a great interview with Katie Koch. She's the CEO of TCW Group, and I'll show you a couple of the clips from that interview. And she's been the CEO since only February, so she's relatively new. The TCW Group is an asset management company based in Los Angeles, and they've got about $210 billion of assets under management. She also said that the Federal Reserve's interest rate hikes targeted at slowing the economy down and bringing down inflation are going to start to bite. Recession is all but inevitable for the U.S., and investors should be playing defense in that kind of environment. I'd love to show you guys comments. There's somebody who's got hundreds of billions of dollars assets under management of the company she's the head of. And I love when they're agreeing with what you already know. You're way smarter than most investors. You know more about the economy than most people, and probably a lot more than you realize you do. We're giving you premium investor enlightenment. That's what you get here with us. We're going to have a recession because that's the way the world works, she said. We haven't had a real recession for over a decade and a half. While Wall Street has been bracing for a contraction for much of the past 2 years, the U.S. economy has stayed afloat due largely to a resilient consumer flush with cash and a labor market that has remained powerful. And what you know is that the labor market will remain powerful until the recession. And I've showed you before on a chart, the gray areas are recessions, and you'll see that after the recession, when the recession starts, that's when unemployment starts to rise, not before. And everyone's talking about how great it is that we have low unemployment. Well, that's the point. It's going to be low until things shift. When you get into a recession, then it starts to build, as it does every time. She also said, we haven't seen the pain of higher rates, but it's coming. She may be a subscriber to this newsletter, I'm just realizing.
I would say that we're probably actually more bearish than most people about what lies ahead from here. And we think that the economy is likely to deteriorate more than consensus.
From an investment standpoint, Koch recommends a mostly conservative array of choices that includes cash. She also spoke favorably of agency debt, mortgage-backed securities, and treasuries, as well as companies that have long-duration capital. And I always say, when you are going to go into a recession, you should be having a lot of dry powder, have some cash on the sidelines to take advantage of what's going to be numerous opportunities all around you that are not available yet, not visible yet, but when you go into the recession, things change. The things politicians are telling you will be reversed. They'll go back on their word. The recession is going to change everything.
So as part of that, just the overall lag effects here, we really haven't seen as much of an impact, I think, as many were expecting on the real economy from just this historic rise in rates. Is that partly in your estimation due to the lag effects? And if so, when and how do they ultimately show up?
Yeah, I think that the lag effect is real. I think it's reasonable to say that, and this isn't going to be very brave, but it's true, and true things are important. We are going to have a recession because that's the way the world works. It moves in cycles, and we haven't had a real one for over a decade and a half, except for a short blip, which we all know. So we have a lot of excess we need to work out of the system. I think some of it's worked out, and the cushion's much thinner, and we can unpack that in more detail. But there is more excess to go. And the longer we go until we get that recession, the more leverage there is to the downside. So I'd first say that.
One of the things that's going to change is a lot of bargains are going to emerge. And if you have cash on the sideline, you can take advantage of those. And also be cautious of a lot of the speculative stuff. Technology companies are very sensitive to interest rates because they have a lot of debt. So you don't want to be getting too involved with a lot of speculative stuff. Don't try and get the next home run. Koch worries about consumers as well as companies that have used the extend and pretend strategy to put off paying down loans. The consumer and small and medium companies are going to struggle to finance themselves in this environment, and that further leads us to a relatively bearish outlook, she said. Welcome to the beginning of the endpoint that I've been telling you we're going to for a long time now. I was definitely early, but it's all playing out exactly as you expected. You knew this was coming before anybody else did. And a lot of people still don't know. I think the majority of people have no idea how bad this economy actually is, how much trouble we're in. Just because a politician goes on in front of a microphone and says, the economy is strong, and people go, yay, it's strong. It's not strong at all.
Things break. So you asked about the lag. There is a lag, and more things are going to break. We've already broken a couple of things, or almost broken them. We almost broke the UK pension market, and we broke some regional banks. And there's going to be more dislocation ahead, clearly, as capital reprices.
So what do you do about it? I'd suggest you educate yourself, learn more so you can make the decisions. Everybody's in a different situation. You each have your own approach and experience level and what's best for you, your own income level, your own expense level. But each person needs to have an idea of the whole picture of what's actually going on. Things that I'm expecting is for real estate to come down, commodities to increase in value, US dollar to come down, and of course, a lot more bankruptcies and defaults. And we've seen a lot, but that's not the end of it. We're just on the upswing still with this, unfortunately. It's important that you get excellent investor understanding right now. A little bit of investment enlightenment is what we're trying to give you because it's a really serious time. You have to take this serious because there's going to be a lot of hardships. And I don't mean to bring you down or talk about all this negative stuff, scare you or whatever, but it's a fact. It's just reality. I don't like it. You won't like it. Nobody will like it. But the people who are in charge took us down this path, and there's not really a lot of good ways out of what they've done. A good example of that is how they just delayed the government shutdown for 45 days, and they're acting like they solved the problem and kept people from having all these horrible outcomes because the government was going to shut down. They didn't do anything except delay it 45 days. That's really bad. If these people, well, they wouldn't ever get hired to work for me, but if they worked for me, they'd last about 3 days before I'd kick them to the curb. They don't know what they're doing, but they're in a place where they're supposed to, so they pretend like they know what they're doing. They're not making the right decisions for the economy or for you. There's a complete lack of fiscal responsibility in any aspect of any governmental organization. I believe the next few quarters, like the next 6 months or so, are going to be the most pivotal 6 months in the economy that any of us have ever seen. Which way we're going to go is going to be completely clear in a matter of months from now.
I just want to end by saying the other reason I would be cautious about getting involved is that you are getting paid to be patient right now. Cash has a good return. And so being defensively positioned for us, being in high quality investment grade debt or in the securitized space, I think we have an agreed philosophy around owning agency MBS, or cash. Treasuries, these things are all paying to investors. And so I do think it pays to be patient and wait to see those higher rates work through the system. We haven't yet seen the full pain of higher rates, but it's coming.
Please subscribe to the channel, click like, and everyone says it, they say to do that. And the reason they do that is it really helps get the channel out there. You get to have your channel be put in front of the eyes of a lot more people. And I think that there's some good messages here.